Hello, in this lecture we're going to define accounting cycle. According to Fundamental Accounting Principles Wild 22nd edition, the definition of accounting cycle is recurring steps performed each accounting period starting with analyzing transactions, continuing through the post-closing trial balance, or reversing entries. So this is going to be the continual step. This is the process that we will be going through during the accounting process, and we'll repeat this process once it has then been completed, hence the cycle. That process starts with us entering the data in some format, the normal day-to-day types of transactions. Then we generally have the adjustment process at the end of the time period that we will then be making the financial statements. And then we'll create the financial statements from the adjusted trial balance. And then typically we will have a closing process and possibly reverse some of those adjusting entries after that point in time and start again. So for example, we could have the journal entries. Here's the transactions related to the day-to-day transactions, us entering the sales, entering the bills. Then at the end of the time period, we can think of oftentimes a worksheet where we take the unadjusted trial balance, what has been compiled through those transactions, and then make some types of adjusting entries in order to make the accrual process correct as of the date that we create the financial statements, thereby getting to the adjusted trial balance here. Then we're going to use that adjusted trial balance to create the financial statements, including the balance sheet, the income statement, and the statement of equity, as well as the statement of cash flows possibly. And then we will have the closing process, meaning we want to close all those temporary accounts, which will include the income statement accounts, revenue and expenses, and the draws account, leaving us with that post-closing trial balance after that process, which is just going to be the permanent balance sheet accounts for the most part, allowing us to then move forward to the next time period and record the activity for the next time period in terms of the temporary accounts starting from zero, counting upwards. And then of course we might have some adjusting entries after the post-closing trial balance to reverse some of those reversal entries from the adjusting process. And then of course we will repeat this process